How does the passive investing and kind of that disciplined plan mesh with active strategies and kind of this world of the individual investor who thinks they can pick stocks? Probably not going to be very good at it, but there are professionals who are pretty good at kind of active management, et cetera. How do you kind of balance those two things as you think about just portfolio management in general?
Okay, so the base case, what I like to call asset allocation for dummies, is it doesn't really matter what you do, going back to what I said earlier, but the starting point for almost everyone, if you don't have a waypoint or a compass, is what I call the global market portfolio. That means if you went out and bought the entire world of public assets, and the things that are missing in public world is private homes and farmland and some private real estate. But if you were to buy every public asset in the world, what does it look like? You end up with a portfolio that's roughly half stocks and half bonds. And of that, it's roughly half US and half foreign. And that's a great portfolio as a starting point. But most people want to kind of skew that depending on, what their own interests and start to tilt away from there. 90% of what I talk about in our research, our white papers, our books, is the final 10%. We wrote if you remember back, again, probably too young, but back decades past, they had this old food pyramid where the government recommended what people should eat the most of, and then sparingly all the way to the top. And it's funny to look back on because the base for everyone used to just be carbs. It was like bread, cereal, pasta, pizzas, like totally inverted today on what people think would be good advice. And the same thing probably applies to your investing, but in general, you do the big muscle movements first. And are the things at the top worth doing? I think so. I have a lot of departures from the standard advice, but this goes back to a John Bogle quote where he says, I set up indexing work for him, for example. Are there approaches that are better? Sure, but there's infinite worse. And so finding one that works for you is important. It's easy to say, to set your risk tolerance, to say, look, I'm fine losing 50%. And we talked about, a lot of people used to ask me, hey, Meb, this get rich portfolio, how do you hit 20% returns? How do you hit 30% returns? And I said, here's some ways, but frankly, most of you probably can't handle it. Because on paper, you say you can handle down 50, down 80. And then when it hits the fan, you probably can't. And we did a tweet, and this is kind of happening in real time. I said, usually don't see bad behavior until people see minus 20. And then it gets exponentially worse every 10 down from there. So that's the base case, what I call the global market portfolio. And if anyone did that, it's fine. By the way, there's a 2,000-year-old portfolio called the Talmud portfolio, where it says, let every man invest a third of his wealth in land, a third in business, and a third keep in reserve. So I call that real assets, stocks, bonds. That beats the vast majority of institutions over time. We've done some articles called why Cowper should be managed by a robot, why Harvard should be managed by a robot, how to clone Ray Dalio's all-weather Bridgewater. All of these are pretty hard. This 2,000-year-old portfolio does a pretty good job of replicating what all these do with thousands of people, tons of fees, tons of effort, headache. You just buy this portfolio, done with it. Okay, so that's the base case. Now, let's say you want to start tinkering with that. And by the way, my personal portfolio largely mirrors the Talmud portfolio, which is, I do it a little bit differently because my background, my family on my dad's side came from a farming background in Kansas and Nebraska. My old man grew up on a farm, straight up, no running water, all that stuff. So farming is sort of in my blood. So a third is in farmland, a third is in private businesses, because I know that I'm friggin' horrible about behaviorally selling things. So over 150 private companies, and then there's the public assets. Okay. I think there's some important tilts that make a lot of sense. And the two big foundations, the pillars to which to build from, in my mind, are nothing new. It's nothing that we've invented, but that goes back 100 years. So one, over 100 years, goes back hundreds of years, but famously 100 years in the US. One being value. So Ben Graham, one of the most famous people to talk about that. And then on the other side is what I would call trend following and momentum, which Charles Dow, creator of the Wall Street Journal, but also talked a lot about trend following early 20th century. We talk on valuation first. It's actually pretty easy to come up with an estimate of how stock market's going to do the next 10 years. This isn't my equation. It's actually John Bogle's equation. One of the greatest contributors of the well-being and success of investors all over the world, particularly in the US over the last 50 years. He wrote a paper in the 90s, and I call it Bogle's formula. Obviously, he would never say to use it for timing or forecasting, but he would say just to set expectations. And it's super simple, and it's 3 variables. You want to know the stock returns for the next decade. It's starting dividend yield, then it's dividend growth, and then it's change in valuation. And that's it. Now, the dividend growth, you can kind of explode into inflation and real dividend growth, or you could also call it earnings growth, but same thing. So historically, and I'm going to round here, going back to 1900, the dividend yield up almost around 5%, gone are those days, although they may be soon coming back, depending on what the market's happening today. Dividend growth also almost 5%, and change of valuation should be a wash. Over ending 2019, there was a slight edge to that in the U.S. as the U.S. stock market got more expensive over the past 120 years. And so you can plug in parts of that equation and find out where we are. So at the end of last year, dividend yield, let's round up and call it 2%. Let's say you got the same dividend growth as historical. And the nerds out there who are listening, by the way, the dividend growth is actually a little bit higher than historical because of the way buybacks have sort of changed that equation. But it's a wash mostly because the inflation's low. The big variable comes with a change in valuation. And so we ended 2019 at a long-term price earnings ratio of around 32, I think. And historical average is around 18. Now, if you have low inflation, you could say it's around maybe 21. So it's high. Again, it's not crazy like the late 90s or 45, but it's high. And so you can plug that into the equation and say, look, John Bogle said this before he passed, by the way. He said investors should expect, I think, low single-digit returns in the U.S. stock market for the next decade. Now, his point wasn't sell everything and be done with it, but rather just to lower expectations. Take your medicine and maybe save more or just have realistic. And Vanguard publishes very similar returns. The problem, of course, comes that most investors expect 10%. Always, every survey. Natixis just did one where they surveyed investors all around the world at the end of last year. They expected 11.7 real. So you got to add on inflation. And I think the survey is probably not fair because most investors have a hard time distinguishing between nominal and real. But really, that means like 14%. But even at 11.7 is crazy because markets have never returned that in history ever. So the problem you see is this massive dislocation between valuations. So that was the bad news. But you put that in the US and you say, look, every quant shop on the planet, AQR, Research Affiliates, GMO, yada, yada, would say low single-digit returns, expectation. Some would say even negative. So pretty bad opportunity set. Now, the good news is the rest of the world is cheaper. So we'll use end of last year, and then we can update it. Foreign stocks were trading around average valuations for low inflation, so let's call it 21. Emerging market down around 15, and the cheapest bucket, cheapest quartile was down around 12. And historically, tilting towards value has been a great way to add, let's call it 1 to 4% returns over market cap weighting. The problem is, obviously, it comes in chunks. It doesn't happen every year. And as we've seen this year, it certainly can get worse. And the beautiful thing about valuation is it's hard, right? The stuff that's cheap. So end of year, we're talking Russia, Brazil, Greece, Italy, Singapore, Norway, just nasty. Who's who, the worst countries of geopolitical, of economic news. The price is because they've already declined 60, 80%. And on the right side, the good stuff that's hitting new highs, everything's rosy. At least it was a few months ago, right? The U.S. lowest unemployment on record, had the first decade in history with no recession, the first year in history, calendar year, where the stock market went up every year in 2017, on and on, right? Everything looks great. But one of the biggest things about using valuation is it's not just about buying the cheap, where there's massive career risks. Nobody wants to own those names, because if you do and they go down, your clients say, what are you talking about? We own Russia and Brazil and Greece and Italy. You're fired. If they do great, they're pat on the back, which they're supposed to do. Everyone wants to own the expensive stuff. But using valuation is every bit as much about avoiding the expensive as it is investing in the cheap. And going back to our examples of avoiding the US when it was the largest market cap country in 1999, avoiding Japan when it hit a P ratio of 100 and has had negative returns the next 30 years. And that's not some backwater economy, right? Japan is still the top 3 economy in the world. So doing those two things is hard. That's why you make it systematic. You put the rules in place. You have it so that you tilt towards value. I mean, look, this is Warren Buffett 101. It's not that hard.